Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, May 15, 2017, looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. As you can see today, we began a push higher with the SPY or Spider being up about 1/2%, a little over $1 up on the Spider. We got to a high today of $240.44, I believe. Yes, that was the high, $240.44, just 6 cents off the minimum target that was identified a long time ago at $240.50 to $241. I think that we will get even higher this week, meaning we'll get into that range. We may even hit the 241. We could pierce through it a little bit, but I don't see the market getting much higher than that this week. We are in the middle of options expiration week, which means we do need to expect the unexpected. So expect upside in the market, but also expect downside in the market. You will have a day or two during the week where the market has a wider range than the norm, as the options traders at the big institutions will generally try and whip out the individual investor, the retail trader, and make some options expire worthless, or at least appear to be doing that, and therefore that's how they make their money. This week is really the money week for the professional options traders. So just be aware that you'll probably see some whipsaw going on during the week. However, we are on the way to the upside target, $240.50 to $241, pardon me. And then at that point, I do think that we'll see the market stall out a little bit, have a little bit of a pullback, and not necessarily have a lot of downside activity, as I do think the market has higher potential before this bull rally is all said and done. Let's take it one step at a time. Let's get to the target, and then we'll assess it from there. So all in all, there's really not a lot of change other than the fact that we've began the upside move that was expected up into that target range. Looking over at the IWM today, we saw a nice up move in the IWM, up 0.75%. And you can see here that the 50-period moving average on the daily chart did provide support 2 or 3 times. We didn't touch it on Friday, but we came close, and we touched it a couple of times, bounced off of it, and now we're fighting with the 20-period moving average. We were higher today, sold off a little bit, but all in all, the IWM was certainly the leader on the upside today, being up 0.75%, while the Spider was up less than 0.5%. And this could be, this pullback in the IWM could be a liftoff for higher prices. However, we're pretty far from the highs in the IWM, considerably farther than we are, obviously, in the Spider. And that being the case, on this current move, I'm not looking for the IWM to break out to new all-time highs. They may test the highs, they may not get to the highs. I'm certainly not looking for an all-out breakout to new highs and continuing higher in the IWM. That's not what I see in the cards for this market. If the IWM was powering forward and we were at new highs, I may have a different outlook on how high this market could go on this run, but this is one of the things that's holding us back, us meaning the market back, from considerably higher prices, at least currently at this point in time. I think with the IWM, it's worth taking a look over at the long-term chart one more time. We do this from time to time, and you'll see here this long-term upsloping trend line. And the market's been riding this trend line, and that's really not necessarily a bullish sign when the market's riding the line like this. It's very hard for the market to break out from a pattern like this. This is not a pattern of a breakout nature. It's more of one that's going to stall out. And if you remember last month, in the month of April, We pierced through it, and we obviously pierced through it each and every month, but we pierced through it in April, and right at the end of the month, we sold off and closed back below that line, and that, in my mind, is an important development. I don't see us closing above there this month. Anything's possible, but that's not what I see happening. And if the market, if the IWM, is not able to close above that line and make new highs, this line from the monthly chart, then it supports the case that this market's going to run out of steam, whether it be in June or at the outset, July. That is the longest I see this market having upside potential into, let's say, the first or second week of July. I just can't see any more upside in the market coming after that point in time. All right, let's go back to the daily chart. We'll take a look at the transports. And in the transports, it was a nice healthy update today. Similar to the IWM, it was up 0.75% today. Nice move in the transports. And you can see this line here that held, this line from last week, held on one touch of the line. However, we're coming into the convergence of the 20 and the 50 period moving average right above price. And that will provide a resistance point. If the transports are going to get above that line, obviously we can trade through that, not the line, but the convergence of the moving averages. Obviously we can trade through it at any point in time on a strong market. However, we may see at some point in time, if the market has more bullish potential, we may see the market gap above that level. That happens more often than not when there is a certain resistance point that is tough for the market to get through. You'll see the market gap above those from time to time, and that, in a sense, gives the market the clearance to move higher. But this convergence of these moving averages will provide a resistance point. From a shorter term perspective, we can look at any of the charts, the transports or the spider. They both look the same. When you look at the hourly chart, you can see here that we're putting in a bullish pattern, and you can see where price was supported today. It was supported at the high of the prior consolidation point right up in here, okay? So the prior highs over here where the market failed became support, okay? This was resistance, the market was rejected, and now this is providing support for the market, and you can see that happen this afternoon. We bounced off that level, and we'll see if we can trade higher over the next several hours, meaning into tomorrow's session. Just to bring it up, the spider looks very similar to the same. Here's the hourly chart on the spider. We're making a bullish consolidation up in the upper range. This is setting up to go higher. This should go higher tomorrow if this pattern plays out. All right, let's go back to the transports, go back to the daily chart. And as you can see, pretty much not a mystery going on here in the market. It's pretty much doing, for the most part, everything that we anticipated it doing. It doesn't necessarily happen on my time frame or your time frame. It happens on the market's time frame. But all in all, we've been able to pinpoint, for the most part, the price action that has occurred, and nothing should have come unexpected. Financials, why not? The XBD, nice bullish pattern starting to break higher. Obviously, we're still going to have resistance at this red candle high that comes in at 220.25. However, that bearish close on Friday was corrected today by getting above, staying above, and closing above the moving averages today on the XBD. And you know what I say with the financials have to participate if the market's going to have more upside. And today we had a nice move, well over 1% in the XBD, and you'll find a very similar move in the XLF. The XLF shows up 0.75%, but you can see it's much of the same pattern. The only difference here in the XLF is we have a resistance point at the 50 period moving average, which is the, the blue sloping trend line. But this is a bullish pattern. The market was consolidating in a wedge format, a wedge formation, building energy for another move higher. That's what's happening right here. So don't be surprised to see the XLF and the XBD trade higher this week over the next few trading sessions as the spider reaches our targets and even potentially a little beyond, but I don't think we're closing up at that level this week at all. I don't expect a spider close over 241 this week. That's not what I am expecting this week. Looking over at the gold market, gold was up almost $3 today. We're still supporting or have found support at the 1221.30 level, this black line. That was supportive on a daily basis. We'll probably trade up to the 1242 level, maybe even up into the moving averages. You can see here that the 20-period moving average is about to converge with the 50. I wouldn't be surprised, and there's also a gap fill up here. I wouldn't be surprised to see gold trade up to that level during this week at all. It's still not a very bullish chart going on for gold. It's actually, if I had to pinpoint it, it's more of an oversold bounce condition than a bullish chart setup. However, we can certainly trade higher from here, and I do think we will. But along with the gap fill I mentioned and the moving averages, look at all this chart consolidation that's up in this zone here. We're not going to get through that in one shot. It's not going to be so easy for the market to just blow through that area. So that will become a very, very good resistance point for the gold market. So net, not a lot of change from last week. The story remains very much the same. Silver, however, is powering higher, up 1.36% today, even higher earlier. We took a run for this red candle high. That was at 1689. We talked about that last week. And the high today was 16,815. So we're close, and you have the 20-period moving average sloping down. So this definitely will be a resistance point. Why else is it? Because you have these pivot lows that come in down here around the same level. So when you see multiple reasons why a market should find resistance at a certain level, in this case, you have a big breakdown candle, you have moving average sloping down, we're below all the moving averages, which is a negative sign anyway. You have these pivots here, the market will find resistance there. So there's 3 points, and there's chart consolidation here, and there's a lot of reasons on the chart where price will find resistance at these levels or at that level. When you have multiple reasons why a chart should find resistance at a certain level, you have to pay attention to it. The same thing applies on the flip side on the way down. When you have multiple reasons why a chart should find support at a certain level, you have to pay attention to it. They work much more than just the majority of the time. Even if it's for a day, 2 or 3, it will be resistance to the market. Moving along to crude oil, we saw a big move in crude oil today, up 2%. It was up much more earlier, but look where we found resistance. Even though we got through intraday this red candle high at 49.28 and this consolidation point, you see where we closed. We closed down back below that high, which is common and normal market behavior. It's not so easy, just like we discussed just a minute ago, not so easy for the market to just blow through an area like this where the market consolidated for a period of time. We didn't quite get to the 50-period moving average, almost got there today. However, we could get there in the next day or so, but we backed off, and that's normal garden variety market behavior. The market will respect these levels even if we pierce through them on an intraday basis. Generally speaking, it's not so easy for the market to close above certain levels, like, for example, this big red candle high at 49.28, this consolidation point in here. Not so easy for the market to just blow through, any market that is, to just blow through areas like that. Intraday, yes, but at the end of the day, we usually find it has become a resistance point. So no surprise here at crude oil. We did identify the 45.92 area, obviously overnight. that night spiked through it by quite a bit. However, on a daily chart basis, regular trading hours, we did find support at that level. We did get the severe oversold bounce that we were looking for, and now we're going to have some resistance up in this area. We may again trade higher, try and get to the 50-period moving average, but at this point in time, I would expect the market to try and trade a little higher and then maybe put in a consolidation or some kind of a pullback before trading higher. It's not going to just blow through this area. That's not the way the market works. Let's go over to the bond market. Very quiet day in the bond market. They didn't do much, back tested the 50-period moving average, bounced off of it, but all in all, a very narrow ranging day. Not much activity in the bond market. However, we are holding the daily chart support at 150.21, which was, to refresh our memories, the 50% retracement from pivot low to pivot high. What I'm watching for now on the bond chart is for it to see if it puts in a bearish pattern underneath the 20-period moving average, or if we can trade higher. And if we can trade higher, we'll trade into the 20-period moving average. And again, just like we talked about in the prior two charts, all this is not going to be easy for the market to just blow through. It doesn't work like that. We'll trade up there if we can, but then we'll need to pull back or consolidate in order to get up to the next level. That's the way the market works, one step at a time. Obviously, under normal market conditions. A spike higher on some kind of event-driven or news event-related item, that's certainly possible. But under normal conditions, we're not going to just blow through a consolidation point that lasted for 7 or 8 trading sessions. And last but not least is the Dixie, or the US dollar. And you know my feeling in the dollar, headed lower. Another down day in the dollar, got below the 200 period and the 20 period moving average. So we should trade down to a minimum of double bottom here and lower. I'm looking for the bottom end of this channel, and once we get there, or even close to that, we don't have to necessarily get to the bottom end of the channel, but when we get close, we're going to be looking for signs of a reversal, whether it be a high volume reversal, a doji, something of that nature is what I'm going to be looking for, because the dollar may provide a wonderful long trade opportunity into the second half of this year. And with that, folks, I'm going to leave it there tonight. It's everything I intended to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.